Okay, so to summarize the factors we talked about in the past two videos, we have the actual real estate itself, which includes the age and condition of the property, but mostly the area that the property is located in. And then we also have the capital markets, so mostly interest rates, but also the amount of capital in the market willing and able to be used in real estate. So I can't understate how important it is to understand these concepts as they relate to cap rates. Cap rates are the fundamental force behind market valuations. So it's really important to understand and really gain a good grasp of what it means and how it can be changed by various market factors. So to help out with your understanding of it, I like to use this analogy, and it's an analogy of a cruise ship, which represents how the different factors affect cap rates. So imagine this cruise ship, you have upper decks and you have lower decks, and you have middle decks. The upper decks are very, I would say have amazing views. When the waters are calm, you can see, as far as the eye can see. However, in tough conditions, the ship is subject to swaying from side to side. So if you're in one of these top decks, while it's very nice during calm waters, when waters start getting rough due to the winds, the boat starts swaying, and if you're not prepared, it can be pretty rough. Conversely, the cabins on the lower part of the ship, they're closer to the water, so during these crosswinds, they don't get as much side-to-side swaying. They're just near the bottom. It's just the ship does not sway as much. You still feel it a little bit, but it's not definitely not as bad as the top cabins. With that said, you also don't have very good views from the bottom. You're close to the water. You definitely can't see as far as the top cabins can. You got the middle cabins, which are kind of somewhere in between. They have a decent view, but they do rock a little bit, not as much as the top. So what this really represents is a trade-off of risk-reward in terms of cap rate. So we can think of it, just to make it easier to understand. Let's say the top cabin parts are Class C buildings. So in good times, they're actually able to get good rents. The demand is very high. Usually tenants are on better behavior because they know that it could be tough to get another unit if they weren't able to keep the one they're in. So returns can actually be very good. However, in rough economic times, which is kind of the analogy for winds, the crosswinds, the ship is subject to swaying, which is really an analogy for the upper deck going through tough economic times, or the whole ship's going through tough economic times. During these times, you have issues with tenants not paying rent. You have issues with material prices going higher. So if you have a lot more maintenance, like Class C properties typically do, you've got higher expenses in that regard. And just overall, if you haven't taken the necessary precautions, and by precautions we really are talking about operational ability, you haven't put in good long-term tenants, you haven't taken care of deferred maintenance when times were good, you're really going to suffer and potentially even lose the property, or at least be losing a lot of money on the property. Contrast that with Class A buildings, which would be the lower decks. Those properties still have some issues during tough economic times like everyone does, but they're a lot less severe, they're a lot more stable. Having said that, they don't have that high reward factor like you do being on the top class C deck. So you're not going to be having those views which equate to really good returns. So really it's not a question of which is better, but what is your risk reward profile? If you have a high risk tolerance and you want to make as much return as possible, you might be more inclined to class C. If you're looking for stability and consistency and being able to weather these storms, then class A may be more your poison. Class B is somewhere in between. So I like to use that analogy because it's not always a case of class A is better or class C is better. It's really a question of risk and return. And you can know the return from the outset more or less based on the cap rate equation, value and NOI. But risk is very subjective, especially when we're talking about area and condition. It can be very subjective from investor to investor. So it's a bit of an analogy I like to make, is that cruise ship. Continuing it on, everything happens within that cruise ship is the real estate factors. So you can't move a cabin on the lower floor to the upper floor. You yourself can move. So you can go to a lower cabin, you can go to a higher cabin, you can go to a middle cabin, depending on your risk reward tolerance. And throughout time, people are changing. Some people are staying in the same cabin. It's all happening within the confines of the cruise ship. Externally, we have the tides. So the tides are rising and the tides are falling. That would be akin to interest rates. So interest rates go up and they go down. No one in the cruise ship has any control over the tide. You're either, you can be doing things within your cabin, you can be trading cabins, but you have no control over the actual ship and the tides. The ship itself rises and falls with the tides. So this is akin to interest rate. When interest rates go up, average cap rates, the cap rates of all properties, tend to go up with it, and vice versa. When tides go down, the cap rates of all the buildings on average go down to match it as well. So you can kind of think about that as the internal factors, the real estate, the condition, the location, and then the external factors which affect everyone, which is typically the debt markets. So again, a little bit of a silly analogy, but for me, it helped me understand cap rates a little bit better. And the more reps you can get in, the more you'll see how cap rates are used, and sometimes even how they're used incorrectly by others.